Good morning, everybody. Welcome. So the title of our panel today is Where are interest rates going? And I would say for investors, that probably is the #1 question heading into 2025. Luckily, we have a group of specialists on this panel to dissect all things that have been going on with interest rates. Just a quick introduction. My name is Joumanna Bercetche. I work for Bloomberg Television. And I would say if we were having this conversation a year ago, I think everyone would have probably universally agreed that the direction of interest rates was probably going to be lower. The expectation last year was that the world was about to embark on a global easing cycle. And indeed, that did happen in 2024. Most central banks around the world started cutting interest rates. The Fed cut 3 times. The first time was a 50 basis point cut. But towards the end of the year, what we started to see was more cautiousness with the outlook. And the market in the past couple of months has been quick to price out some of the rate cuts that were factored into the curve, but also longer-term yields have started to rise as well. So throughout the course of this panel, we're not just going to talk about what's going to happen short-term, but also some of the drivers of long-term interest rates as well. Before I move on, I also just want to put up a survey that the World Economic Forum did with some of the chief economists that were in this survey, and essentially it's over there. And you can see from that one that economists really are divided about where interest rates are going this year. So orange means that they're expecting further loosening, blue is unchanged, and black is tighter. Look at that. In the US, 12% of economists surveyed actually think interest rates may move upwards this year. The Fed may actually hike. So this is the starting point. Really interesting conceptually, because economists, surprise, surprise, can't agree on the direction of travel. Let me introduce our panelists. First of all, we've got Ron Hanley, Chairman and Chief Executive Officer of State Street. Good to have you with us. Isabella Weber, Associate Professor of Economics from the University of Massachusetts, Amherst. Nicolai Tangen, the CEO of Norges Bank Investment Management. And then François Villeroy de Galhau, the Governor of the Central Bank of France. So we have a Central Bank Governor with us, which means I'm going to start with you. I'm going to start with the newsiest bit, which is over the course of the last couple of days, we got a whole slew of announcements from the incoming Trump administration, executive orders, declarations. But the two things that I guess people who watch interest rates are focused on is the potential application of tariffs and potential policies on immigration, which could, in theory, some people are saying, drive up wages. I know you're not at the Fed, but I do want to ask you from your standpoint, from your standpoint, when you see these types of announcements, are you bracing yourself for an inflationary shock in the United States?
Oh, some words about inflation, and I will keep the European perspective. But we have been collectively, including the Fed, successful against inflation. And if I take the European figures, we were at a peak of more than 10%, October 22. We are now at 2.4, and we expect for this year as an average 2.1, so more or less on target. For the effects of the Trump administration, it's probably too early to tell. We could expect, but I say it very cautiously, this program to have inflationary effects in the US due to tariffs, fiscal expansions, etc., but to be seen. On the European side, I don't think that the inflationary effects will be that significant. So I would expect this disinflation process to go on and our victory against inflation to be final, if I may, because the tensions on the labor and good market in Europe are much smaller, obviously. Which means, if I may, some words about short-term rates and long-term rates and using the very important difference you introduced. On the short-term rates, this is about monetary policy, so this is our responsibility. For the ECB, we were the earliest one to cut last June. We are now the lowest one. We are at 3%, while the Fed and the Bank of England are above 4%. And I would say that for the quarters to come, probably our task is the simplest also, due to the fact that we are vigilant but confident on disinflation, as I said, and we are still quite far of the neutral rate, which is probably estimated to be around 2%. So, seen from today, but it will be data-driven, to expect our policy rate to be around 2% by next summer is a plausible scenario, which could mean a decoupling, let us be clear, between ECB and Fed. But decoupling is not an issue. Both of us are independent on both sides of the Atlantic. The question of long-term interest rates.
So when you say next summer, the news person in me is asking, you mean summer of 2025 or summer of 2026? The market is pricing in 100 bips, 2% by December 2024.
Sorry for my English ambiguity, because I this summer, 25.
So 100 basis points cuts by the midsummer.
We will see. Again, it's data-driven.
Well, it's just more aggressive
I am
than
a
what the market is pricing in.
You are a journalist. I am a central banker.
Yep. Okay.
But no, on long-term interest rates, this is a different story. Here there are spillovers, obviously.
Yeah.
There is also a very significant difference of levels. If you look at the 10-year interest rates, it was yesterday about 2.5 in Germany and 4.6 in the US. Mm-hmm. But there is some kind of core movement or core rise in the last month. It's a partial core rise, but what explains this rise in the US? Perhaps a technical explanation, which is important. As you know, when you look at long-term interest rates, you can have two explanations. You can have monetary policy expectations. So the succession of short-term interest rates forwarded. And then you have the term premium. What increased in the last 4 months is the term premium. Mm-hmm. And this reflects increased uncertainty. It's about inflation fears. It's about too lax fiscal policy, starting with the US. And it's about global uncertainty. To say it with other words, and I will conclude with that, but this is a very important point on the direction of interest rate. There is a risk that the benefits of disinflation and monetary easing is weighted or lost by increased uncertainty, economic fragmentation, and a too lax fiscal policy. Or to say it in other words, an economic policy, in order to be efficient, including for growth, must be consistent. And this is a very important lesson for both sides of the Atlantic.
Really interesting. Thank you. Ron, I want to ask you from the perspective of, you have oversight of what investors are doing and how the flows have evolved over the last couple of months. What have you seen in fixed income, quite simply? And is there anything that would explain this backup in yields that we were talking about, specifically in the US, by the way?
Yeah, no, Joumanna, it's a good question. In fact, I would say that it's quite consistent with what François just said. So just given our role, we service institutional investors and we manage money, and about 15% of the world's assets passes through, financial assets passes through our doors. And when you look at those flows, running up to the election, it was fairly stable. There was not a lot of change. There's been a long-term, meaning the last couple, 3 years, overweight to U.S. equities from around the world. Right after the election, there was yet another bump up in inflows into U.S. equities, interestingly coming from U.S. investors. Non-U.S. investors stayed at what was a high level, but didn't add to that, didn't take away from that. But what else happened was even more interesting. Outflows from emerging markets. I think this uncertainty, and I think François is using the right word, is uncertainty. Uncertainty around what the election of Donald Trump meant for emerging markets. And fairly significant outflows from long-dated debt. Again, uncertainty around what to expect on that, and in my mind, actually contributing to this term premium increase. The other thing that we observed is that cash levels still remain at very, very high levels amongst real investors. They're off from the peak, but still very, very high. And it's hard to say what that means. It could be more uncertainty. Let me keep some money on the sidelines and decide what to do. On the other hand, the more optimistic way to think about this is there's a lot of money waiting to be deployed.
Nicolai, have you changed your, let's stick with short-term interest rates for now, I'll get to long-term, but have you changed your view on what the Fed may do this year?
No, so I don't spend, well, first of all, I generally don't have a view on interest rates. I'm just trying to look at where is the risk. And I focus not so much on the short term, I focus on the long term. And to me, the biggest risk we are seeing now is the US long end. That we could see a proper backup on the back of the things you talked about, you know, less labor supply, tariffs and so on, with high budget deficits, very high debt levels. And I just fear that there is a moment where investors suddenly decide we want to be paid much more to lend money to governments.
Yeah.
And I think that's the biggest risk to financial assets.
So I was going to say that because I've spoken to a lot of people the last couple of days, especially American executives. They're pretty excited about the prospects for the US economy this year. Everyone seems to be raring to go because of this pro-growth agenda, pro-business agenda that's going to be pursued by the Trump administration. And because I'm a journalist, as the governor pointed out, my question is, what could go wrong? Where could things go wrong? And yesterday, one of the market participants said to me, keep an eye on long-term yields. If, say, 10-year gets to around 5%, and right now we're about 4.5, 4.6, then that could have negative ramifications on broad financial assets. Do you tend to agree? Should we be watching what happens with long-end yields?
That's the one we should be watching.
Mm-hmm. Yeah. And why do you think that's the case?
Well, because that's where you see, the inflationary pressure expressed.
Okay, Isabella, you've written a lot about inflation and the inflation drivers, and perhaps maybe from an academic standpoint, why do you think inflation is proving to be a bit more of a challenging beast for central banks to tame than it has been in the past?
Yeah, so I think in rich countries, we had the privilege that we didn't have to think about inflation very hard for a couple of decades, and then it kind of took us by surprise that the supply shocks that were unleashed first by the pandemic and then the Russian attack in Ukraine were more inflationary than most anticipated. And I think this has to do, on the one hand, with these shocks hitting essential sectors, hitting what I've been calling systemically significant sectors in my research. This is sectors that are essential for human livelihoods, that have high weights in the consumption basket, sectors that are very upstream and have a high multiplier across the economy. Now, what we have seen is that these shocks, these cost shocks, have not been absorbed by the rest of the corporate sector in the ways in which many had anticipated, but that in fact, these cost shocks functioned as a sort of coordinator for price hikes, where it became kind of safe for companies in one market to hike prices because there was this clear signal that this cost shock has opened up a window of opportunity for what market participants have liked to call taking price. So this means that we have seen this more persistent inflationary effect that came from supply-side shocks. And I think a lot of the things that we are looking at, if we think about the next couple of years, are also in the category of supply-side shocks. I mean, tariffs at the end of the day are supply-side shocks. If we think about retracting from climate change mitigation, and we look at what happened in LA, I mean, thank God it didn't hit the LA port, but very likely that extreme weather events can hit critical infrastructure in ways that it can create supply shocks. If we look at the Panama situation and we think about the amount of trade that goes through the Panama Canal, then again, this could be supply-side shocks that could come with inflationary risks.
Speaking of supply-side shocks, Governor, what did central banks learn from the COVID experience? I mean, there was a time when central bankers were telling us that the shocks, the supply shocks, were going to be transitory in nature, and of course, they proved to be quite persistent. Do you think that this time around, central banks will be a lot more alert to these potential supply shocks and therefore react quicker if they emerge?
No, I agree with Isabella's point that supply shocks are probably the name of the game for the years to come, and they will become more frequent. Having said that, not all supply shocks are alike. Some of them are transitory. Look at what happened on energy and commodity prices after Putin's war in Ukraine. It happened to be transitory. And this is part of the disinflation we observed. Having said that, some of the shock came to core inflation and it appealed, it required a strong and swift response from monetary policy. In the future, we don't know exactly what kind of supply shocks we will have. You mentioned some possible ones. There will be surprises. Some supply shocks could be less inflationary or even disinflationary if there are productivity gains with AR or such things, but we will see. It means probably, I cannot say for the years to come whether inflation, forget about the Trump agenda, which is again for the US due to tariffs and fiscal expansion, probably clearly inflationary in the short run. But if I look in the long run, it's difficult to say whether these supply shocks will be as a whole inflationary or not. We will have to adapt. But for sure, inflation will perhaps be higher, but for sure more volatile. And this is for us the key challenge. So I am an advocate of what I call agile pragmatism, but I think we will need it definitely and be ready to answer. It also means, if I may add one point, that central banks are not the only players in the room. Because we can deal with demand, we can deal with cyclical effects, we cannot deal with supply. And this calls for structural reforms in order to improve supply everywhere. And frankly, this is a political challenge.
Yeah, Isabella, I want you to jump in here because I know you've also written a lot about that and the need for creative solutions to tackling these potential inflationary shocks. So tell us more about what you've written.
Yeah, maybe to take right off where you left it, I think there can also be a potential contradiction between hiking interest rates trying to tackle inflation, where if this inflation is coming from the supply side, and hiking interest rates makes investments more expensive and actually can undermine the kind of investments that you need to come forward for resilience, so that you kind of get into a catch-22 where you do something to tackle inflation that actually makes the kind of measures that you need to take to increase resilience less likely to come forward. Now, given that I think there are some pretty identifiable points of vulnerability from a sectoral perspective, I agree that where exactly the shocks will hit and what exactly the ramifications will be is very hard to predict, but I think we can know which sectors are the ones that present greater risks than others. So energy is a big one, shipping is a big one, food is a big one, just to give some examples. So I think we have to think about price volatility in food commodity markets, we have to think about price volatility in energy markets, we have to think about the ramifications of extreme increases in freight rates. And I think that if we look, for example, what the Biden administration did with with releasing oil from the Strategic Petroleum Reserve, I think that's the right direction of travel, but I would argue that this needs to be consistently counter-cyclical. So they did release when prices go up, but they didn't buy when prices were collapsing. Had they bought when prices were collapsing, they would have actually stabilized production and would not have prepared the grounds for the kind of price spikes that came later. So I think buffer stocks, counter-cyclical stabilization in extremely volatile commodity markets that are bound to become more volatile in geopolitical and climate change environments that we are in is an important tool to be revisited.
Yeah, in your New York Times article, you start off by writing the unemployment weakens governments, inflation kills them. So to your point, it's an imperative for governments to keep a tab on what's going on there. Nicolai, you wanted to say something?
Yeah, I think it's interesting, you mentioned the food inflation. I think it's interesting how that's now linked to climate in a different way that has been the case historically. And we argue the reason why we care about climate at Norway's Bank Investment Management is because it is a financial risk. And we are seeing it on the back of climate changes. We are seeing worse harvests. We are seeing impact on olive oil prices, coffee, cocoa, and so on. We are seeing the inability to work in the middle of the day in a lot of places, taking productivity down. We are seeing it causing immigration. We're seeing it causing conflicts. So it's just a totally different picture here than has been the case in the past.
Yeah. That's a really interesting perspective, and perhaps we'll talk about that when we talk about long-term drivers and our star and central bank speak. Ron, what is the level of concern right now amongst the business community in the U.S. about rising long-term yields? I mean, I'll tell you, as being somebody who works in the media, financial journalist, we do spend a lot of time talking about the term premium that is being priced into the US curve, the size of the US deficit, 7% this year, the fact that long-term yields are moving higher. But how worried are people about the long-term actual trajectory of deficits in the US?
Not enough.
Not enough?
No.
Okay.
I mean, I certainly, if you get a gathering like this of informed people, yes, there'll be some discussion on it. But if you think about the election that we just had, there was zero discussion of it in the election. Neither candidate talked about it, and neither candidate has talked about any kind of debt reform. And I would add, I'll come back to the question, but I would add, when we talk about the pressures on here, Nicolai talked about climate, which we do believe that the need to decarbonize. People talk a lot about all the money that can be made off things like renewables or Tesla cars and things like that, but there's going to be enormous investments in adaptation. And it's very hard to make money off a seawall, right? It's very hard to make money off cutting down or limiting where housing can be built so that forest fires don't become city fires. And the cost of adaptation will be inherently inflationary. Secondly, we haven't really talked about demography and immigration policy. The US demographics looks no different than the rest of the world. It's been masked by fairly favorable immigration. Certainly not as favorable as it's been in the past, but relatively favorable. I'll give you a statistic. There were, over the last 2 years, 450,000 net additions to the US labor force of American-born workers. It's not that we haven't had a lot of children entering the workforce, but we've had a lot of people retiring. 450,000 is less than 2 months' worth of job creation over the past 2 years. The rest has come from elsewhere in immigration. So supply shocks happen in a couple of ways. They happen the way we saw it in terms of the kinds of cutoff of shipping and things like that. But they also happen because you don't have laborers there. And what it's going to mean for agriculture, what it's going to mean for construction, and those inflationary pressures.
Yeah.
And all that is going to create, in our view, a bigger debt problem. And there's not enough attention being paid to this. And it can go on until it doesn't. I mean, the U.S. has...
But the U.S. is the world's reserve currency.
Well, that's the point. It doesn't have to think about it as much as us. But at some point, somebody's got to buy the debt. And at some point, if the buyers back up, and some of the natural buyers of debt aren't there any longer, right? China's not going to be the same kind of natural buyer in the future that it was in the past. And I think that's why you're seeing this rising term premium. So I do believe that this will become a problem. It's a question of when.
Nicolai, do you think this is a problem? I mean, we spoke about earlier 5% being sort of, a line in the sand, but I'm saying bigger picture. Are there going to be problems down the track? And you look at the case in Europe, for example, a lot of scrutiny on UK gilt yields rising in tandem with the US right now. And the UK has different fundamentals than the US economy.
Yeah, no, these are, of course, different fundamentals. But, we had the trust moment in the UK. The thing is that you just never know when it's going to come and why it's going to come and what's going to cause it and how big the impact is going to be.
Yeah.
And it can go on and be hunky-dory for a long period of time, and just suddenly you have some failed auctions. People want to have, better pay for what they do and for the lending, and it's impossible to predict.
Yeah.
But at some stage, you'll get there.
Yeah. So I guess you have to hedge as an investor somehow, look for hedges in that space. Governor, I want to come back to you and just, we talk about some of the drivers that could actually, all of these things for me speak to higher interest rates because we talk about the long-term inflationary drivers. So you're in a position where you're embarking on an easing cycle without perhaps a lot of clarity on where the neutral rate may be. What you thought was the neutral rate in the past may not be the neutral rate of today. Therefore, you may end up perhaps in a situation where you're too loose versus what the economy demands. How do you think about that?
No, this is the beauty of our star, as you know, that it's a very interesting economic tool. It's a border between restrictive and accommodative monetary policy. A very useful border, but it's not observable.
Yeah.
So you can put the border where you want. To be more serious, ECB estimates give a range for our star in the euro area. I will only say it for the euro area. In nominal terms, between 2.5 and 1.7. So average, take it as an average with much caution, 2.1. This is why I quoted around 2% by this summer. About the trend of R star, we have no, obviously we had a structural decrease of R star for the last 2 decades, let's say till COVID. This move stopped. In our case, we have no evidence of R star rising again. It's more or less stabilized. But I would say it cautiously, it might be a bit different in the US. Mm-hmm. Can I come back to what Ron said about fiscal policy? Because to be honest, it's also not much of a political object in our European debate either, and I regret it too.
And you're French?
But not only in France. And here we have to be more consistent in fiscal policy and in the policy mix. During COVID, it was simple. We had to have monetary easing and fiscal easing. So they went together. Then we had inflation, monetary tightening, and in many countries, still fiscal easing. Now we have again monetary easing, and clearly we will have it further on our side of the Atlantic. But fiscal consolidation is still waited for. Yeah. So it's a challenge in the US. It's a challenge also in several European countries. Can I add one dimension, which I think is completely missing in the fiscal debate? Because you have the quantitative debate about the level of deficit and the recommendation. But you have what I would call the qualitative debate. What are the fiscal expenditures or tax credits for? And I think it's very important in the environment Nicolai and Ron and Isabella described of adaptation, climate shocks, supply shocks, to have more investment and less current expenditures. Fiscal expenditures must be long-term oriented, growth-oriented. And believe me, we are not yet there, again, on both sides of the Atlantic. So I stress this qualitative debate, because if not, fiscal policy will not be growth efficient.
Yeah. Isabella, I'd like you to pick up on that, and the fact that monetary policy does not operate in a silo. So how do you see the intersection between fiscal policy and monetary policy?
Yeah, I mean, I think we have seen a very interesting development where the United States has been on a quite unique path of very expansionary fiscal policy and great monetary tightening at the same time, where Europe has been in a more conservative fiscal environment, and while at the same time also imposing monetary tightening. And I think it's pretty clear that the growth performance of the United States was far superior to Europe. Of course, there were other factors, like, for example, the negative trade shock from energy to Europe and the positive one for the United States. But nevertheless, I think there is an important lesson here where we can see that you can have this very unorthodox combination of fiscal expansion, monetary tightening that can actually deliver interesting results. I would say that in terms of looking at debt projections, of course, it's also important what is happening on the growth side and what's happening on the tax base side, right? So if we have strong growth in the United States, but at the same time we drastically erode the tax base, then of course that is going to grow the fiscal deficit. But if you have a stable tax base and you have strong growth, then some of that growth can also offset some of your fiscal trends. So I think in the European case, where we have had very weak growth and where we also have a situation, speaking with a German accent here, where the economic model that has long been driven by exports is becoming very precarious. I think that domestic demand has an important role to play for growth. And here, actually, I would say that stimulating consumption, even if it doesn't change structural drivers of growth, can play a very important role in this geopolitical environment.
Certainly the bigger question for Germany. Nicolai, I want to show you a statistic. I'm just going to read out the statistic. Well, it's not really a statistic. It's just I'm telling what the market did. So the Fed cut rates by 100 basis points from a peak of 5.5%. The 10-year yield in the US has risen by 90. The ECB also cut 100 basis points. And today, the 10-year bond yield is lower. Right? So US yields have gone up and 10-year German yields have gone lower since the respective central banks have cut interest rates. How much of that is just a growth question in Europe and these questions about the long-term productivity, competitiveness of a...
I think I should pass that on to you.
Well, let me, but I do want to ask whether you're worried
Nicolai, you are
about...
not allowed.
Are you worried about European growth?
No, I am worried about that. But, you know, it just as an extension of your comment, IMF has made a calculation, I think then I would say that worldwide government debt is $100 trillion. That's the right number, right, roughly? What are the implications of that?
No, if I may add one word.
How worried should we be about it?
I'm not that worried, but we'll come back to it. If I may, on this growth question, it's part of the explanation, and obviously Europe as a whole has a growth challenge. This is not something new, but we have also part of the answer, and it refers to what we said about structural reforms. Ursula von der Leyen gave yesterday here in Davos a powerful speech about the Draghi-Letta agenda, and we should definitely wake up there. And if the US economic policy program has one use for Europe, it's a very powerful wake-up call. And this is a common challenge to all European countries, and not only Germany, clearly. I guess it's only part of the explanation for this. I spoke of a co-move on long-term yields. It still plays a role. There are transatlantic spillovers. When US long-term yields rise, there is a tendency of part of it coming to Europe. So we cannot say that on long-term we are decoupled. But it's less so than in the past, also due that probably the fiscal picture for Europe as a whole is more, how could I say it, more reasonable or more balanced than the US one. But there are very different situations in Europe, and some countries have obviously to change their fiscal curves, including my own country. It's also true for Germany, Isabella, but in the opposite direction, probably. So the German challenge is a bit easier, although I am aware that the political debate in Germany is very hot. But clearly the priority number one for Europe, and its answer number one to the new world we live in since Monday, is structural reforms, its growth and innovation agenda, and we know what we have to do. And this is structural. This does not require fiscal expenditures. It's free eyes, if I may, integrate more the single market, invest more thanks to private savings. And we are lucky enough to have significant private saving. This is a famous savings and investment union. And third eye, innovate more and faster with less red tape and less bureaucracy. It's quite easy to tell. It's a bit more difficult to implement. But remember, I have enough seniority to remember 30 years ago. Some of you perhaps remember this word of Eurosclerosis we had in the 80s. And it was true. It was the first challenge. And we were energetic enough together to answer with A, the single market, and B, the single currency. I think it's such a time today. And Europe, if we act, could be a turnaround play, or to say it in financial terms, a value stock with less growth, but also cheaper investment, and obviously this upside of the structural agenda. No, our growth destiny is not only in American or China's hands. First and foremost in our own hands.
Okay, strong statement. Ron, I want to come back to you and to encapsulate some of the themes that we brought up. You seem a little bit more cautious just about the direction of travel for the US economy and potentially the rising debt situation. Do you think that sentiment has actually got ahead of fundamentals now in the US?
So I'm not cautious about the short term. I mean, the short term is almost going to become a self-fulfilling promise. But I do think some of these forces actually are negative, right? We talk about deglobalization, we talk about decarbonization, et cetera. We talked about all that. So I think there are risks to the medium and long term here in that. And I think there's Listen, there's a lot of enthusiasm. I do think that the situation in the U.S. is not as sclerotic as you said in Europe. There certainly has been some excesses in regulation that are probably going to be rolled back. I mean, with any kind of policy changes, you have to make sure that you're, to use the American slang, not throwing out the baby with the bathwater, right? And there's a danger in that. I am confident that some of the things that have already been put in place aren't going to change. Right? I thought it was very interesting, right, that the CEO of Exxon came out and said, the U.S., you should not pull out of Paris. Right? Now, he said that not because he wanted to be in Paris, but at some point you make it, these are very, very long-term decisions.
Yeah.
Right? You make a decision, you stay with it. We can't be coming in and out of this. And so I think at some level, the direction of travel is set. We have to remember ourselves that the biggest producer of renewables in the world is the state of Texas, right? And is that going to change, right? Are they going to start tearing down solar panels and tearing down windmills? I don't think so. So at some level, we probably shouldn't be worried about this, but I do think these forces of what it really means to deglobalize, what it really means to have these tariffs, what it means to no longer be as integrated as we were. I think these forces around what it's going to take to actually to mitigate and actually adapt to some of these climate changes, that's going to cost us money. This debt problem, we now pay about 3.1% in GDP in the U.S. to debt. That will more than double in the next 10 years. Right, just no matter what changes between now and then, that will double in the next 10 years. So what does that actually mean for medium to long term, the health and monetary health of the U.S.? And again, I'm not making a prediction, but it's a risk that has to be priced in.
Yeah.
Can I
Yeah,
add
and then I will.
one sentence on that? I would like to support 100% what you just said, and keeping the long-term objective. It's key for climate. Can I give another example in my own field? Financial deregulation can be extremely dangerous in the long run. I'm the first to say that we have room for improvement on financial rules, room for simplification, including in Europe. So let us go towards simplification. But to deregulate on cryptos, to deregulate on non-banks, could possibly, I hope I am wrong, prepare a financial crisis to come. And on banks, Basel III is also conceived to prevent the comeback of such financial crisis. The worst thing which could happen to US growth and to global growth would be in the future a financial crisis. So let us be cautious about this question of financial deregulation. Let us be active on what I would call simplification.
Nicolai, what? Yeah.
I just want to, sorry.
Please, yeah, Isabella.
Well, just to follow up on regulation, I think regulation is the key to this. So I was in the US just before Christmas. We spoke to 50 CEOs. 9 out of 10 thought that business was going to be better, partly because of a rollback of regulations. Now, are we seeing any rollback of regulations in Europe? No, we are not. I think it's very tough to see it because regulations, when they come into place, they've been working on it for 18 months. And it's the job of some people to make regulations, not to get rid of them. Now, what can happen if you get rid of regulations? You know, one of the most incredible things that happened in Europe over the last 5 years, what is that? It's the rebuilding of Notre Dame. In 5 years' time, they undertook one of the most amazing projects, which normally would have taken, I don't know, 25 years. It took 5 years. Why? Because they were allowed to disregard regulations and rules. Unbelievable what Europe can do if they're allowed to do it, you know?
Yeah, maybe one quick point on the regulation question. I think we also have to see the medium to long-term harms that deregulation can bring, for example, in the environmental field. I mean, you don't see immediately if your water standards aren't the same anymore, if your pollution standards are deteriorating and so on. But like in the medium to long term, that can have implications for demographics, can have implications for the very basis of your growth. But I wanted to jump in on the question of European growth prospects and prosperity. politically. And I think that there's a lot of important points in the Draghi report, I think in particular on energy prices and energy price stability. I think there are some very important points. But I think that there is a danger of overlooking the cost of living crisis, of overlooking the question of how is Europe working for the majority of ordinary people. And if we don't address this, I think looking at the polls in France, looking at the European Parliament election, looking at the German polls, looking at polls across Europe, there's a very real danger that the far right will come into power, which could deteriorate the European Union in ways that all the hope for continental size markets and so on is undermined politically. So I just want to make a very strong warning that I think we need to make sure that in these growth agendas, the interests of ordinary people are addressed in a direct way and not just as a trickle down in the next 5 to 10 years as a result of capital market union or upstream innovation and so on.
Yeah. Nicolai, I'm going to give the last word to you before we open up maybe for 1 or 2 questions. But what advice would you give? I mean, you benefit from being a long-term investor to allocators thinking about the long term and what you think the biggest drivers are going to be for a composition of the portfolio over the medium term, long term.
Well, I think if you're a long-term investor, you need to be just widely diversified, and you need to be spread on all the asset classes. Tactical asset allocation, I don't think has helped anybody. Very few people make money by moving capital around. Typically, you just run into the next hottest area, and I don't think you add much value by moving things around. So I think it's to have just a very long-term strategy and stick to it.
Okay. All right, I'm going to open up to questions. And while I do that, I think we're going to put up a screen now with a code you can scan, a QR code for that chief economist's report that I mentioned at the top. There's a full report put together by the World Economic Forum. If anyone has a question, please put up your hand now. The lady at the front.
Thank you. My name is Nongulu Legonye Mbezi from South Africa, Standard Bank Group. Could you just give us a couple of sentences on China and Japan? Are you expecting deflation out of China and Japan finally breaking the back of that? What's the expectation there?
I'll start on that. I mean, I think that China's been has represented the vast majority of global growth for the last 30 years. And I don't think we can expect that going forward. And it's something that the world needs to be thinking about. And a lot of the prosperity that was enjoyed, even in places like the US, was a result of that, what had gone on in China over the last 30 years. But we all know some of the pressures that China's facing now. It's got its own demographic problem, which is far worse than many other countries in the West. It's got its own debt problem, particularly provincial debt, that it's got to be dealing with. And it's got its own, if you will, political ambitions that are running counter to some of the long-term economic ambitions of China. So I think that's not a bet against China, but it's a belief that China will not be the same kind of propeller of world growth as it was in the past. I mean, Japan does look like it's actually, whether it's broken the back, as you said, of this, but it's certainly a different kind of situation that we've seen in the last 30 years. And in fact, in some ways, China's starting to look like Japan in the so-called Japanification of China. The relative size of the economies are that even if you have a very, very bright outlook for Japan, it can't become China.
Yeah.
So there is a bit of an offset here, but not enough.
All right, one last question. No? Okay. It speaks for itself. A contribution from Isabella. Apologies. Oh, and Governor. Okay. I missed you. I was so focused on the audience. Apologies.
So I've actually been working on China. I've written a book on China. I've been studying China's reform progress in the last couple of decades. And while I agree that I don't think China is going to be the kind of driver of growth for the world that it has been, I would really caution against thinking about China from the perspective of Japan's experience. I think that the political model is very different. I think that they are aware of the challenges of rebalancing for more than a decade, that they have a very long-run vision, that they are conducting experiments on the provincial level, that they are very creative in finding very unlikely policy solutions in ways in which I think we haven't seen in Japan. So I would be slightly less pessimistic on the China question.
No, I wanted to thank Nicolai before concluding for quoting Notre Dame. Living in Paris, it's an obvious thanks. It's perhaps a possible conclusion on this question of simplification and regulation. Let us take the positive lessons of Notre Dame. I do agree, without forgetting the negative lessons of Los Angeles, which you mentioned, Isabella. And this is a fine balance. Will there be enough political support? The question you raised. To be seen, but I think fiscal policy is the most difficult political object.
Yeah.
But if you take capital markets union, I think it's less difficult. And if you take simplification, there is even, in the so-called populist vote, I don't like this expression, call it protest vote, there is a strong aspiration to simplification, if you look at this. So if we use it in a smart way for a growth agenda, I think there could be a way forward under the banner of Notre Dame.
That is, I could not possibly articulate it better than the governor, so that's a good place to leave it. Thank you so much, everybody, for watching our panel. Thank you.
Because I missed